There we go. Well, good morning. This is Andrew Horowitz, and it is Friday, August 15th, 2000, and actually it's the 16th today. I think it's the 16th. Yes, it's the 16th of 2019, and I am back from deep parts of Africa, South Africa, in fact. Had an amazing time there. If you haven't had the opportunity to go to South Africa to taste the food, the wines, and of course enjoy a safari, you don't know what you're missing. It's exhilarating, it is delicious, and the wines are pretty good. So you have to check that out. It's an incredibly long ride. It takes, well, from Florida, it took about 20 hours overall, kind of going from Miami up to London and then down to Johannesburg. Then you got to hop on a plane to Cape Town if you want to hang out there for a while. And if you want to go on a safari, you have to go to a little airport called Hoedspruit, which is pretty much a grass hut of a terminal. And you get off the plane and pretty much your bag's just waiting there for you. But we are back. It has been a very volatile session. Kevin Hoffman took my place for the last two sessions, and I looked at those recordings. There was some really great nuggets of information there that was available. So hopefully you were able to attend that and spend some time understanding more about what's happening with the markets, because the volatility has spiked dramatically. So what we're seeing right now is a continuation of this seesaw action with big moves on either side, which is the hallmark of not an uptrend, a hallmark of a downtrend or corrective action in markets. In fact, when you see those kind of moves, those 500 and 600 point moves in the Dow, either up or down, it is not something you look at and say, hey, wow, we're in a great market that really allows me to look at long-term investing. It's much more geared towards traders, intraday, scalpers, et cetera, which is what we're going to talk about and what we do talk about here each and every week. Do me a favor, for those of you that are on the stream right now, give me a quick kick back here and let me know that you can see me, you can hear me, that everything's looking good. Is my video moving around? Looks like my video is kind of frozen. Hey, Kevin, let me know if the video is working properly, please. I'm going to stop that video for a second and then start it up again. There we go. There we go. At least I can see it moving now. All right, everything sounds good. Oh, video's frozen. Hopefully the video is back up and running right now. So I probably look ridiculous just talking with no mouth movement there. But nonetheless, let's get on and look at what's going on here and take a look at the screen to this side here. Of course, this is for educational purposes only. It is nothing more than that. We are not looking to give you advice, recommendations, or any trading information right here. We want you to learn from what we're talking about today, use your own tools and some of our tools as well to, in fact, look at the markets in a way that we look at it, which is based on volume and price. You find that this idea of looking at markets with volume and price is really one of the best ways to look at it, because we can understand where the traders and institutions are really looking to put their money, where they're really placing their bets overall. So with that, let's take a look at this on the right-hand side of this disclosures, and everybody can read that at your own leisure. We'll leave that up for a second, and then what we're going to do is we are going to get into the weekly update. So where are we? We're definitely in an ugly tape environment. There's no question that there is an ugly tape that's going on right now with that 800-point drop for the Dow, 3% across the board for the NASDAQ and the Sp500 at the beginning of the week. The hopes for a little bit of a, I don't know, a change in discussion points when it comes to China. We're not seeing that right now, though. What we're seeing is the same thing where China says, no, we're not doing this. And the USA is saying, yeah, they look like they want to do a deal. We're seeing that the USA is saying they're buying our agriculture. China's saying, we're not buying your agriculture. China's saying, hey, we want to come halfway. We're thinking about maybe we can meet somewhere and do a little bit of something. And USA is saying, no, we're not meeting you halfway. So if this is anything different than a stalemate, somebody has to tell me what's going on. It looks to me as if there is just a simple stalemate, and it's, well, not going anywhere too quickly. If you really think about this, this is going on about 18 months right now. It started in the beginning part of 2018. And where we are right now is nowhere, we're worse. We have more tariffs going on September 1st, and possibly in December, an additional tranche of tariffs will be going on. So this is really hurting a lot of areas like retail, industrials, and a whole host of other areas. When we look at what's really happening also and what's moving markets, this inverted yield curve, which you've been hearing about, right? Everybody's been hearing about this, right? I mean, it's all over the news. The concern about negative interest rates and the inverted yield curve. These two things are really shaping up what has been going on lately, and this idea that there is this central banks that are pushing on stimulus to such a point that we are overburdening the system in a way. As a matter of fact, you look in, for example, Sweden today, the entire yield curve is negative now for the first time ever. Just 2 days ago, we looked at a chart. I'm going to show you that chart right now of the amount of negative yielding debt, sovereign debt throughout the world. This ramp up that we've seen here, look at this incredible ramp that we've seen from 2000, well, going back to 2015 when this whole experiment started, to where we are today with this ramp from the end of 2019. And this is showing about $15 trillion. Well, when we look today, this is only a few days old. We're almost at $17 trillion today. Another $2 trillion got sunk over the last few days. And that is really concerning because this experiment is based on the idea that, hey, you know, one of the things that's going to happen here is if we have negative interest rates, it's really good for the consumer because there's going to be some more money that's flooding in the markets. Banks will not want to hold money on the balance sheet of the various central banks. And the money will go somewhere. Where's it going to go? Well, flood it to the streets. So I don't know what's going on with the video today. We're just going to stop the video today. Because it's, we'll start up one more time. It keeps on freezing. I'm not sure what's going on there. But when we look at this whole idea of interest rates and negative interest rates, the problem is that it is really hurting a lot of sectors. Look at the financials in all these countries. Look at what's happening in Germany. And it's not increasing inflation. So one of the areas that is really starting to hurt and sees a lot of problems, even though we saw a really good level of consumer spending and confidence, is retail. Take a look at this chart to the right here. I mean, we look at retail and you look at what's happening over here, we are at the lows that we saw back in 2016. This is a monthly chart of the XRT, the Sp500 Retail ETF. You're seeing that this is hitting multi-point lows again, clip below it, but right on it, trading today at 37.81 pre-market, not going anywhere. 37.78 is the monthly low that has to look out for. But look at this. Here's what's interesting that you want to see, okay? This level from 37.78 on a monthly basis down to about 31, this area right here, that's a big concern. You have to look at this and wonder, hey, what's going on here? So when we look at this situation and we find that there is a breakdown like this in the consumer, and we realize that consumers are backing off, you have to wonder, okay, well, what are we doing next? You know, where is this going next? So let's click over here. When I look at this tape and I look at retail, but I see technology doing really well. I see utilities doing really well. I see gold doing really well. What does that spell to me? And add to that the whole volatility factor. The video froze again. We're going to just leave that off. Well, what we see is that there is this incredible amount of concern in the markets right now. So there's this big yield curve jitters. Look at the 210s right now, this chart we just created. When it goes red, it's a negative. In other words, the 2-year is higher than the 10-year. And right now, we're not seeing that, right? We're seeing it just at about 5 basis points off of an inversion. And why that is important is that it is pretty much in the idea in the heads of many people that there is a direct correlation with regards to the negative spread of the 2 and 10 and the potential for a recession in 6 to 12 months later. And there's a lot of reasons for that. There's a lot of correlations for why that's happened over time. There's a lot of a review of, well, we've seen it before, therefore it's going to happen again. It may or may not. We're a little bit of a different environment right now because of all the negative interest rate yields around the world. And it is probably pushing down on the yields of the US because it's very attractive to grab a 10-year or a 2-year. That's a positive yield as opposed to a German yield, which is negative 0.75% on the 10-year. So when you look at this and you think about, okay, well, where are we right now and what's happening with regard to the overall, the market when it comes to bonds, it's a very concerning factor from both the spread rate basis and the negative yield and where we're going. Don't forget, we were looking at a 3% 10-year just several months ago, and that's dropped down. The 30-year has dropped below 2%. These are not good things happening in the markets right now. So that's where these jitters are coming from. So these big moves, we saw better than expected retail sales. Housing starts are okay. China is horrific. Europe just looks like it keeps getting worse and worse and worse. And what we have coming up in the next week or so is ECB stimulus. They've already signaled that they're going to put some stimulus out there, and also more and further and more and further trade talk discussions with China and the Fed minutes next week. A couple of things before we get into the stocks that I want to go through. Number one, make sure that you're on the mailing list for the webinar updates. You'll be getting updates if you are registered for the webinars on a regular basis, one day before, an hour before. Also, if you are a new subscriber to the Commander Series over at TriggerCharts, available for TradeStation, which we're going to go through in a second, you are eligible for the 4-hour online coaching program that's free. It's $199 value. So all you have to do is sign up and become a paying subscriber, which is $149 per month, and you simply then on your way. There we go. We'll look at GE, what happened yesterday and today. There was some interesting news today. Beyond vile meats, I call them, the SPY, the Qs, some of the banks, and a few other things. Before we do that, I want to get into this and take a look at this chart here. These two charts that we created, it is on the left-hand side, it's the NYSE Composite Index on the top, and you see that big rollover, again, getting down towards these support levels that seem to be bouncing off a little bit right now. On the mid part of this here, when we're looking at the center section, what we're looking at is right here is the McClellan Oscillator. It's at a negative 132. Get down to that negative 200 range. It's usually an area that you want to look at for loading up. Gets too hot, we start worrying about it getting a little bit too much and overvalued. You saw this divergence right here compared to what happened here. So we saw this move up here, divergence, and obviously it resolved much lower from there. And we saw that intermediate point that right about here got a little bit low and then popped up. Here is the 52-week high, new highs and new lows on a daily basis. We're looking at right now 144. You saw that we got new highs really peaked up very substantially. And anytime you see that, that's also oftentimes a sign of excess in the markets when people are really pushing things up dramatically. And you get down to the 50 range, 60 range, start questioning whether or not that's an issue on the downside. On the right-hand side, we got the Sp500 index. And then on the bottom, we have the Spearman. I like to look at this because anytime you do see the Spearman get below negative 90, see it a couple times here, those are oftentimes areas that you want to look at for oversold conditions. Some of these things you can actually see when we look at the KRI. Let me make this a little bit bigger for you. And very similar action. There was a cluster formation right there that was a buy signal. And this is a really cheap indicator. It's so inexpensive, available. It only looks at the SPY. It only looks at the broad market. That's all it's doing. That's all it's telling us, is that the broad market is either oversold, overbought, too hot, too cold. We give you a little bit of an explanation over to the right as well, kind of a little gauge graphical representation of what's happening here. And you saw that we hit that -4. I like to see these levels here. Those are, you get a combination of an oversold, multiple clusters, these dots, and then this magenta color, that's a back up the truck moment right there. Here we saw a lot of overheating going on right on the top. Did resolve a little bit lower over time. Same thing here, same thing here. You saw that peak up and it kind of rolled back over. Did not see that here, which was, I thought, pretty interesting. So the sentiment indicators, when it came to that, were not so overdone, but yet there was other factors that really caused some problems. Let's take a look at this. What do we got? Let's take a look at, let's go through this list here. Let's take a look at the SPY real quickly. Let's take a look. I'm going to expand this a little bit. I want to show you the daily. We look to train on the daily because I think it's a little bit better of a look, an easier way to look at it. But you could do this on a 30-minute, 10-minute, any of the charts, any time frame you want, whether it's daily, weekly, monthly, 10-minute, 5-minute. It doesn't really matter. It works the same. I like to keep my minimum to about a 30-minute because I think 30-minute is a little bit better in terms of qualifying the data. So on the top right now here, we're looking at the SPY. SPY really has no position at this current time. You can see it's inside of an altimeter, inside of the top, middle, and bottom portion of this range. We're seeing the coloration is a gray, which means it's in consolidation mode. You saw this really nice level. Let's kind of mark some of this right here. So this really nice short point right here. I made a bunch of money there from, where was it? About 300 and change. Right by actually 297 down to about 285. It closed you out of the position on the short position. Tried to get long a couple of times, didn't work. Kind of took you right out at the point. Not much loss or gain on that. There was some better moves, I think, that weren't so quick and sudden, that were beneficial in other areas. But right now, we're seeing that there is this volatility. I would stay away from this. We got a wide pattern right here, the range. And when you look at this, when I say range, what I'm talking about is the width. The width of the box is getting kind of wide right here. You know, versus kind of these are stacked pretty evenly, a little bit thinner. This is a really wide box right here. Those are areas that you want to be concerned about. And on top of that, more importantly, what I like to combine is the momentum indicators that we have with the aileron. And you look at this, and I mean, look at this. This is in the negative territory here. This is saying, hey, you know what? Be careful. Smooth sailing, be careful. Be careful, smooth sailing. So you combine the aileron, which is a separate subscription. It's a 10-day free trial for all these, by the way, if you want to check these out. I know a lot of you have, and that's why we're the #1 rated indicator on the TradeStation trading app store, and thank you so much for that. But on top of that, what's really interesting is when you combine the concept of, okay, where are traders laying their money down? Okay, we know that there's some support here, but what's happening, we still see a downtrend. Now, when I look at this, I see that there's an area, I'm going to kind of, this area right here, see this right here? Aligns pretty well to over here. This is my kind of target right here, about 276 on this. There's a little bit of congestion in between here, but nothing substantial. You got a drop and a corridor from about 283 down to about 276. That's something that I would look for. Where do we go on the upside? On the upside, I think you have a lot of resistance right at that 289 level. Kind of coincides to this whole area right here going across, where you can see you can combine multiple levels. And in terms of utilizing some of the tools on TradeStation, you can look here, simply draw a line and see where these connect and where there's a significant amount of connection. And that simply looks at the levels that you can find to see support or resistance. So there you go. Those lines, they cross, you know, pretty much got to cross a few of these really strong support and resistance lines. That's where your consolidation is. Right now, we're looking to open up at what? 287, which is about $2 below where that top end is right now. So something to consider when it comes to the levels right now. So without going through this, all these, here's the Qs. Qs the same similar look to them, where you have this consolidation point. You have another breakdown point, a little bit stronger overall support probably here at the level that we're looking at right there. You can kind of connect some of these lines pretty close. They don't have to be exact. You have to worry about getting those lines exactly right, but really pretty close. There's some good support. From there, where do we go? Well, once again, you got this level and this area right here that is right here. Like, you know, you kind of keep on going down, down, down. But I would say this level is probably really good support, right about the one, I would say that's about 179. And then from there, you got some downside action, probably right to, I would say, about 170. Again, when you cross and take a look at this line here, we could just draw that right across. What is that? 170.50 on the Qs. So consider that. Also, start giving me some of your stocks here, and we'll go in and take a look at those for you in a second. But I want to talk about some of the stocks that we see moving. GE obviously is just abysmal. There was an accounting fraud accusation yesterday, and that is moving the stock today. What's moving the stock today? Well, you got the CEO buying in $2 million worth of the stock today, and that's moving the stock up a bit on the idea that, well, if there's fraud, why would the CEO be buying in? On the other hand, you could say, if there's fraud and the CEO knows about it, he's trying to perpetuate this whole thing by making it look good, popping up the stock, and then just making a few points and moving out of it. Something to consider. Beyond BYND, getting into no man's land right here. Kind of drop below that 140. You're going to probably move right back down to 105 on this, on the fake burgers. Bank of America aligned with all of the other, I would say, financials with the negative rates that we're seeing. You know, have you seen Deutsche Bank? Anybody looked at this? Take a look at this chart. You want to see? That didn't work. DB, enter. Boy. Deutsche Bank. No data. That's a little weird. Huh. I have to check in what's going on. There must be a data flow problem with Deutsche Bank. Well, go back to Bank of America and all the banks for that matter. You know, you're seeing that back to kind of stretch this out a little bit. 2019 lows were, right about 24 and change. We're at 26 right now, headed up to 31. Got that triple top that we can see going across there. Where are we now with Bank of America? Probably right here is some support, interim support, maybe down to 25 and change. You need to see these financials participating in the overall market for the markets to move. It's just the way it is. It's just if markets are going to be in positive mode, well, the financials, everybody seems to love the financials. Why not? They make money hand over fist and all sorts of fees. That should be your take on where the economy is and where things are going. And if we squeeze the financials, that's not good for the economy either, because it really constrains loan growth and then money on the street, margin, leverage, all the things that you utilize for your various business activities and individual investments. So the banks have to participate in order to see markets moving well. While we're here, let's see who we are. Got the futures up a bit. Looking good. All right, what else we got here? Overstock. Yeah, some people ask me to look at this stock. Not much going on here. This is just a loser. The idea they were going to do get involved in blockchain and no longer be involved in selling retail. It took the stock up pretty well. Where is this going? I have no idea. Honestly, this is just a disaster in the making. Moves around pretty aggressively. Some investigation now into the CEO working or doing something with the elections in Russia. There was something going on with the CEO a couple of days ago, and that really dropped the stock significantly. Where are we now? Dip buyers are trying to pick it up right now. I'd say support about 1620. From there, you just go down and to the depths of hell. I thought we'd take a quick look at the VIX. The VIX is elevated. The VIX is at 19, hit about close to 25 last week on that big move. Seeing it come down a bit, not that much. Right now, it's down 6% in the pre-market. But you look at these elevated areas, this should be your tell. If you don't know what that symbol is, it's $VIX.X. Important to track that. DDS, another casualty in retail. Macy's came out a couple days ago, horrific numbers, 10-year lows. Dillard's has been just getting smoked. Right now, it's trading at about 48. Closed yesterday about 56.59. Going to trade somewhere down off on my screen here. But this you can see this momentum really ticked down in July very significantly after that that acquisition issue that was going to happen and some other news that was going on. A great shorting opportunity. And you saw the momentum change dramatically here and then move into this negative. And then you got that short call right there. What a beautiful short call, right? It's 72. You see that? That's a beauty. Just absolutely beautiful. These short calls on these retails have been really nice. Same thing with Macy's. Macy's got a short call at 21, now trading at 16. Let me take a look at some things for everybody here. We got gold, GLD. How pretty is that? Isn't that a beautiful thing? The Commander Series and Altimeter Autopilot got you in right at about 134, currently trading at 143 on the last trade. A couple of different times got you in over here too at about 126, took you out about 135. Consolidated for a while, nothing happening. This is kind of a really good lesson in something where you want to see these vertical moves move higher quickly over time, and consolidations kind of move in a horizontal pattern. See that kind of back and forth, and then a breakout finally happens. Same thing with silver. Silver's been pretty nice too. Look at these great trades. You would have had these wonderful trades. Very simple, red, green, yellow, very easy to use. That's the whole point. I built this for myself. I like it. I like things to be easy. I don't want to have to think all the time and do 1,200 calculations. Remember, you get a 10-day free trial with these, so make sure to go over to the trading app store. I'm going to try the video again. Hello, back. Go over to the trading app store and check it out over at TradeStation for your 10-day free trial. And of course, check out all the reviews, check out all the things that are going on there. These are relatively inexpensive traders that professionals use. This is the kind of trading devices and indicators and methodologies that are built for professional traders. These are available now for you. It's $149 a month for the whole package for the Commander series, where you get the altimeter, you get the autopilot, you get the multiple time frames. See this time frame, multiple time frame situation on the top here for autopilot, also giving you 5 different time frames that you can look at. Really cool stuff. There's a link over there right now. You can check this out. The aileron, the KRI, there's a couple of freebies in there as well. There's an eco track, which is tracking economics you can look at as well. But something I think that you should really check out. Now the video froze again. So much for that. We'll stop that. I don't know what's going on there. The other one was BWA. I don't know what's going on with that. Oh, maybe there's a feed problem here. Let's see something. Yeah, BWA, is that the right symbol? Trade station's offline. I don't know what's going on with that. All right, well, we're going to end it on that. Hey, I want to thank you very much for visiting with us today. I'm going to cut it short. We're going to figure out what's going on with the video and all that. Make sure to sign up, check out the Trade Station Trading App Store, and we will see you again, I guess, next week. Thanks for being here.